Okay, good morning, everybody, and welcome to MACROACE with your host Tony. I am also the head of the head financial analyst at FinancialJuice. So we've got about less than half an hour, and we're going to try and get through the majority of this. So for the US, definitely for non-farm, and a bit of Canada for their Canadian employment change. So let's get into it then. So what is the non-farm payrolls figure? It's the net amount of jobs created in the prior month. And you have two surveys. You have the household survey and you have the establishment survey. So the household survey, what it represents is that represents the unemployment rate figure, surveying people and workers. Hello again. Hope you're doing well. I'm glad. I'm glad that you're on here again. Seems like you did enjoy it last time. The establishment survey then is where the non-farm payrolls figure is derived from. That's basically sending out a query to 666,000 corporate and government work sites as well. Can you not hear me? You should be able to hear me. I can hear myself. You might want to double check your settings, but I can hear sound coming through on my end. Okay. So as I was saying, you have the establishment survey, which is where the non-farm payrolls figure is derived from, questioning the 666,000 corporate and government work sites about the employees they have on their books, on their payroll. Then we carry on. So how does it affect the markets? Simple. Whenever you do get much higher than expected a non-farm payrolls figure, that will lead to an appreciation in the dollar, and usually leads to a depreciation within the stock market in this current environment, where the Federal Reserve is still in their tightening phase. They're not completely. Well, they said they gave the hint that they're done, but leaving the door open for potentially another hike as well at some point. But usually for the stock market within a non-tightening environment where the market conditions are normal, then usually it is positive and bullish if you do get a stronger than expected non-farm payrolls figure. And then for the bond market, we also get as well is for bond yields, stronger than expected data. Again, bullish for the bond yields. Again, anticipation of higher yields. Higher rates from the central bank, and also that the demand for the stocks, starts to increase if the U.S. economy starts to do well. Hence the reason bond yields go higher in order to try and attract that investment. So, kind of what's going on. I mean, not to do with the job market, but with the overall treasury market, how the yields are not high enough for those who would invest in a bond or take a jump into bonds, are not high enough, and that's what has also helped the rally that we had seen, or the strengthening in the bond in the treasury market. Although we haven't completely uninverted from within the inverted yield curve, it is, and I did put out an image earlier on in the day on the FinancialJuice newsfeed of how that's starting to then go from an inverted yield curve to a flat line instead. In about, and that's quite important to note, that if usually with a yield curve that's not inverted, and if you're seeing a nice steady slope towards the upside, it usually represents going back to normal conditions within the economy. But just to make it simple here again, if the data is stronger than expected, then bond yields see a rise, again because of the expectation that the central bank may continue to raise rates or hold rates for longer than or traders will speculate that the central bank will hold rates for longer at a high rate than what was previously anticipated. Then indicators weighing on sentiment then. So inflation was unchanged at 3.7%. PC price index year on year was slightly down by 3.4% compared to 3.5%. GDP Q3 was at 4.9% compared to Q2's of 2.1%. ISM manufacturing employment, which we had this week, was at 46.8 compared to 51.2. The ISM manufacturing PMI at 49 compared to 46.7. ISM services employment, which the ISM services data will come out today at 10 a.m. Eastern time. But the services employment from the last round was at 53.4 compared to 54.7. The PMI was at 53.6 compared to 54.5. JOLTS job openings this week was at 9.553 million compared to 9.61 million. And employment costs ticked up to 1.1% compared to the prior and what was also the forecast of 1%. ADP employment change was at 113k compared to the prior of 89k. And average hourly earnings in the US was at 4.2% compared to 4.3%. So one thing I want to highlight is with the ADP employment change figure, the release itself. Usually that is what a lot of traders do is they use that the ADP employment release as a way to gauge what kind of direction non-farm payrolls will go in. That's not the right way to think about it. And I'll tell you why. Because the ADP employment change figure doesn't have a very strong correlation with non-farm payrolls. And when I say that, an example would be if ADP employment change came in higher than expected, you won't always get that correlation or that correlation that non-farm payrolls will also have a figure that's higher than expected. The way we should be seeing it with this jobs report data from ADP is how will the markets react to a positive or negative figure? Okay, will the markets or will the stock indexes see a decline if non-farm payrolls is higher than expected, or vice versa? And how will the dollar react? Because that's how you want to, and again, that's important to understand as to what was the past reaction of some of those other jobs data and how it affected the market. And then that'll give you the indication as to what the sentiment would be if non-farm payrolls were to come in lower or higher than expected. So this is one thing I wanted to kind of talk about. I'll show you the ADP employment change figure and how the markets have reacted. It was quite minimal, to be honest. I didn't add it to the deviation sheet because the reaction was quite small and there wasn't anything really notable other than gold, which had seen a little bit of a movement, but other than that, nothing else. But let's go through the triggers then of what economists are expecting for non-farm payrolls. So non-farm payrolls, they see a high estimate of 235k with a 55k deviation and a low estimate of 125k with a 110k deviation. Unemployment rate with a high estimate of 3.9% and a low estimate of 3.7%. Average hourly earnings with a high estimate of 4.3% and a low of 3.8%. And then finally, the private payrolls with a high estimate of 200k and a low of 80k. The previous report on September 1st, job gains occurred in leisure, hospitality, government, healthcare, professional, scientific and technical services, and social assistance. And then just to kind of break down some of the key numbers then, or the numbers that had come out from there. Healthcare added 41k jobs, leisure about 96k, government 73k, social assistance about 25k, and transportation and warehousing about 9k. And then if we carry on, so Fed and government views, what do they see? So if we're talking about labor costs, so this is something that is quite important for the Federal Reserve's fine-tuning of their monetary policy. So labor costs, we've seen this week on Tuesday, that the rise in compensation reported by the Labor Department, it was slightly stronger than expected. And that helped to explain the surge in consumer spending the last quarter, which contributed to the fastest economic growth pace in nearly 2 years. Fed's Harker on October 20th said that the US job market remains surprisingly strong. Fed's Logan, October 19th, said that the jobs market is not as hot as a year ago, but very strong overall. And then Fed's Powell said that wages are not the principal driver of inflation so far. So we do still, doesn't mean we're going to throw off the average hourly earnings data that comes through, but it's, again, it's more about, from what Fed's Powell says, is that there are other factors that are going to affect inflation. And of course, and we're talking about not only consumer prices rising for consumers, but then you also have prices that might be rising or might still remain too hot for producers making the goods, and those that are providing the services as well. For not just consumers but also businesses as well. So there are those factors too. The other factors would be that if the jobs market continues to heat up, then that will increase the likelihood of more people taking on jobs that are available, and the more people that have jobs and gain a wage, then they have a higher opportunity or higher chance of using the spending or using the salary that they have on the goods and services that they need, and then maybe starting to spend that more on the luxury goods as well. And then again, then the cycle of inflation starts to pick up again. So this is what I want to talk about with ADP, and why we need to understand we're not focusing on whether non-farm is going to come in higher or lower than expected compared to if ADP was higher or lower. We need to focus on what the market reaction was like. Okay, and I think a lot of people might misconstrue it with thinking, oh yeah, non-farm is going to be lower than expected. Like I said, there isn't a strong correlation. So if we're looking here at the ADP employment change, it came in lower than expected. You'd seen the S&P 500 see a move towards the upside and the dollar take a little bit of a hit. Again, the overall market reaction wasn't that great. And of course, you had other things that the markets were focusing or looking forward to, which was the Federal Reserve and what they were going to do. So it kind of took a little bit of a backseat this time around with ADP to the FOMC. But we need to understand here that good data is still bad data for the markets, for the stock indexes and the risk assets. But of course, and very clearly here, if data is lower than if data is bad, then it's bad for the dollar overall and its currency pairs. Does that kind of make sense for everyone? I hope that kind of clears up if anyone had the idea of how to kind of interpret the ADP employment change data. And I won't lie, when I started getting into started getting into the trading business and looking at news and the economic data bits that would come out, I would think that maybe ADP will, stupidly enough, when I was very young, right, starting out, that ADP might be a precursor to which direction non-farm payrolls would go into. So if I had me now telling me back then, I would have thought of it. Of course, everyone says that in hindsight, but that's the fun of the game. But yeah, so here we go. So that was a reaction. Lower than expected data was negative for the dollar and positive for the stock indexes. And then carrying on. So one of the things for investment bank and research and market views, there's not too much to kind of go through here, but on October 6th, you had a stronger jobs data. But last time around, I was ill, so you didn't actually see me do a live stream for that. So we don't actually have a video of the last reaction that we had, but we can go through the deviations quickly. October 6th, post stronger jobs data. Fed swaps priced in higher odds of a rate increase this year. And Fed swaps shift full pricing of a rate cut to September from July, although now that's changed to June of next year rather than September. Then the SAMS rule. which is quite interesting. So this is, let me go back. So the SAM rule is basically what happens is the unemployment rate, if it hits 4%, that would be a one identification of an oncoming recession within the nation. So we've had continuing claims and unemployment labor flows that suggest that it's taking longer for people to find jobs, and historically, usually that's been a harbinger of more persistent increases in the unemployment rate. So we haven't had a false positive, i.e., where the unemployment rate has hit 4%, since 1960 for identifying a recession. So that's one thing to kind of bear in mind, that, okay, don't follow it to the T, but what I'm saying is that it's another way to kind of think about, right, in a forward-looking manner, what could lie ahead for the US economy if we see the unemployment rate ticking higher. And that might be a bit outdated. Maybe the unemployment rate needs to go higher before the US enters a recession. But that's an interesting thing that I picked up about the rules within one of the things that I found quite interesting when I was doing the research on this. And then you had ADP's Nella Richardson saying that no single industry dominated hiring this month. This is from the ADP employment change figure. And the big post-pandemic pay increases seem to be behind us all. In all, October's numbers paint a well-rounded jobs picture, and while the labour market has slowed, it's still enough to support strong consumer spending. So just highlighting again overall that yes, the labour market is seeing some loosening, and is not seeing as strong as figures as it used to see in the past during the post the pandemic. But that doesn't mean that the economy is going to face major headwinds, that it can still kind of thrive with consumer spending still quite strong. Okay, so actually let me close that there and let's go to Canada. Let me bring Canada along. Okay. Right, so the Canadian employment stuff. So we'll kind of skip through some of this here, which we already know. So we'll kind of skip through that too. Whereas the Canadian economy at the moment, so the interest rate, well, of course, unchanged at 5%, inflation at 3.8% compared to 4%, average hourly earnings was at 5.3% compared to 5.2%, GDP quarter-on-quarter annualized was at minus 0.2% compared to the first quarter of 3.1%, GDP month-on-month was unchanged at 0%, the employment change data was at 63.8k versus 39.9k, and the unemployment rate remained unchanged at 5.5%, and the S&P manufacturing PMI was at 48.6 compared to 47.5. Triggers then for the Canadian employment change data, according to economists, so they see a high estimate of 80k with a 55k deviation, and a low estimate of 10k with a 15k deviation. Unemployment rate with a high estimate of 5.7% and a low of 5.5%, and then the average hourly earnings with a high estimate of 5.3% and a low of 5.1%. Sentiment of views, to be honest, there wasn't too much. If we're being honest, give me 1 second. Okay, so yeah, there weren't really that many, to be honest, people talking about the Canadian employment change data, because of course the main releases were of course FOMC that were going to dominate the week, and the Bank of Japan, the Bank of England, and of course Nonfarm Payrolls. But still, Some of the comments then from the central bank itself, the Bank of Canada's Macklem, said that they held their policy rate steady last week because monetary policy was working to cool the economy and relieve price pressures. And then October 25th, earlier on, he said that there could certainly be 2 or 3 quarters of small negative growth. So the idea that if you do get a weak Canadian employment change data, the overall market view for, or the view from the Bank of Canada, might not change that much, and they might actually just welcome it, to be honest. They would welcome further calling, and then there wouldn't be a need to hold rates as high as they have it for that long, or for less time. So that could be seen as a positive. The only way that the central bank is actually going to change their view if they see that there is a very strong pickup in the number of jobs that are being offered, I'd say for at least a couple of months. 1 month's better data is not really going to, not even a couple of months. You need to see a consistent increase in the number of jobs being added to the economy, and then that might be enough then for the central bank to not only talk about maybe the need to raising rates in the future, but or keeping rates higher, for keeping rates restrictive where they are for much longer than what they might have previously anticipated. And I think it's more that the latter that would happen rather than the central bank raising rates, unless it starts feeding into inflation very, very quickly with the employment change data and the more jobs that are then open up, that are available to everyone else to then to be able to increase their own spending in the economy. On October 19th, you had Deputy Governor Kozichki said that we're seeing signs that monetary policy is working, and we are mindful that past rate hikes will continue to weigh on activity. So similar to what other central bankers have said in other areas of the world, with Bank of England's Stingray, and you've also had ECB members talking about how the transmission of monetary policy to the economy is still feeding its way through, and that it is working, but that's why central banks have been more cautious in how far they go with their rate hiking path and how much they tighten monetary policy, because there's a gap of about 12 to 18 months that it usually takes for the effects of interest rates to then take hold of an economy. So this is something, again, similar to, it's nothing new, nothing that's going to blow anyone out of the water, but it's just showing you that the central bankers are being more cautious, and they're more reliant on the data that they see to then make a decision as to whether or not they continue keeping rates where they are, or in extreme cases now, let's say, to take another rate hike in these circumstances. Okay, investment bank views. So CIBC, just kind of go through this here. Let's get out of there. As this is the last Canadian employment change report that we had. Let's go through the market reaction here. Oh, no, sorry, that is an old video. I think, yeah. So this would have happened. Let me bring up the other video. Apologies, hold on, give me a second. Right, we've got about 4 minutes left anyway, so I think I'll try and get this video in as quickly as I can. No. Okay. Okay, I think we'll leave the video for now. Of course, we're not going to have that bit of data there, because again, I wasn't there. I was ill. So let me bring up the deviations sheet for you, and we'll go through that. I did record how big the reaction was last time round, so we can have a little look at that data there. So let me bring up non-farm payrolls. So this deviation sheet just shows you how strong the market reaction was, depending on what the data, how the data came out. So you can see here non-farm payrolls, last time there was about 166k deviation, which was much bigger than what was expected. So this box here, this figure here, shows you of course, what the asset is. The first figure shows you the initial market reaction going to the wick of the candle, and that's on a 1 minute chart. And then the figure here in brackets shows you the movement 10 minutes after the economic release had come out, going to the end of the candle. And the figure in the blue brackets, hopefully you might not be able to see my highlight, but the figure in the blue brackets represents the market reaction 30 minutes after the release had come out. How much did it move after 30 minutes? So here, so again, the first reaction, or 1 minute reaction there, or the first reaction on the first candle. Where did it end up after 10 minutes of trading and after 30 minutes in the third bracket? Okay, so you can see that the market reaction for, actually, if we kind of go back, was the strongest since Jan 6th. Because of the deviation, or the amount in the deviation. So you can see in the past, even when non-farm might have had a strong deviation, there it still wasn't kind of enough for the markets to then see a similar reaction to what we had seen recently here. So to be honest, if we had a 106k deviation beforehand, then we might be looking at we've got 1 minute left now. Okay, we might be looking at a much higher deviation. So maybe a 100k deviation for a stronger reaction for the non-farm payrolls figure itself. We do need to be careful of the do need to be careful of the average hourly earnings data. If that does tick up higher, or if that is lower, that could moderate how much market reaction that we see. And you could get more of a whipsaw reaction instead if the data is mixed. Okay, let's get TICKSTRIKE up and running as well. Okay. US releases. Okay. So gold decided to have a bit of fun beforehand. Okay. Right, less than 10 seconds now. Okay, 150k, 150k, lower than the forecast of 180k. Let's see, what else we got here? That's going crazy there. Okay, average early earnings, forcible 1%, higher than the forecast of 4%. Ooh, dollar hammering here. Private payrolls at 99k, lower than the forecast 145k. Let's see. Oof, that is a strong reaction to that data there. Yeah, I've got TICKSTRIKE going off my ear. Okay. Okay, so US short-term interest rate futures rise after jobs data. Traders see less chance of a further Fed rate hike. Right, let's do some measurements here. Let's look at the NQ. See what we've got. All right, so not only did you get lower than expected US data by 30K, but you also had weaker than expected private payrolls as well, which also helped. So that's 295 ticks towards the upside on the NQ. Let's also look at the Canadian data too. So CAD JPY, because that's, if we looked at dollar CAD, that's going to be skewed by the US data. Let's see, what do we get here? Okay, CAD JPY. So yeah, CAD also was down too. Okay, so Canadian data, as such, yeah, employment change, so 17.5K. That was low in the forecast of 25K, so it's about 20 pips down on CAD JPY. Okay, and this is quite nice. Okay, so okay. Okay, I'll be back with you in a second, guys. So that's what currently got on the S&P. So we'll see how that goes. But I think I might decide to jump out of it earlier. But yeah, that's what I've currently got at the moment. There we are on the S&P. All right. Okay, so that went well. Nice. Okay, let's look at some of the other areas too. Let's look at the dollar yen. Okay, that's quite 57.8 pips down on the dollar yen. So yeah, positive for the stock indexes. So we had, just to summarize that, the employment data, about we had a 30K deviation there on the non-farm payrolls, the headline figure. You had the unemployment rate that ticked high to 3.9% as well. And then on top of that, you had weaker than expected private payrolls as well. And then average hourly earnings, if I can see the red, where are we? There we are. Yeah, average hourly earnings ticked up by 0.1%. So not a huge, not enough in this situation for the for the S&P to see like a whipsaw, what we had seen in the past when you had seen stronger than expected average hourly earnings data. Now that inflation is more or less coming under control to what the Fed would want it to be. So yeah, so I took so that's what we have there. If we look at gold as well, so a measure of gold. Let's bring the bond. Why'd you go over there for? What are you hiding over here? Okay, come back. There we are. That's your place. Yeah, let's take a look at gold. See, there we go. Okay, it's about 86 ticks towards the upside on gold. And let's look at Bitcoin too, on the futures. Let me just bring it up again. Let's get a fresh view. Okay. There we are. So, how many ticks was that? About 21 ticks. Okay. All right. So that's that there. Hopefully you guys found the information useful. Did you? If you did, then don't forget to give the live stream. Give the live stream a like, subscribe to the channel, get the word out there, and also don't forget to hit that notification bell as well. And then share that knowledge that you have, or share this knowledge that you have with your fellow traders and friends as well. Okay, I'm just going to double check the deviations because I know that of course that there is of course always a little bit of a pullback. I'm just going to double check it for last time, but it might not be in this. We'll see. Okay, let's see what we have. Okay, so the last time round when there was 100 and let me bring up the S&P. Hold on, let me bring up on this chart, this window. Let's see. All right, let's see what we've got. So there's 160 ticks down last time. This is 66 ticks up. So not as big as a reaction last time round. Yeah, I'm good. I'm glad you guys find this information useful. Crazy to eccentric as Tony Rock. Glad you're feeling better. Cheers. Cheers to you too. Cheers to everyone in the chat. Who was listening in. All right. So, but even then, if we're looking at the deviations last time around, even then there was a bit of a pullback. But okay, so it seems like to be a little bit. Maybe it could be this bit here. Anyway, that's for you guys to decide. I'm done with my trading now. I'm happy with where I am. All right. So yeah, but if we're looking at some of the pullbacks, so this remember the bracket in black represents the movement 10 minutes after the release. So last time around, you'd seen 106 ticks down. After about 10 minutes of trading, it kind of pulled back up, and it was still down, but by 143 ticks. And also for that huge deviation from what we had seen last time around, and even on the S&P too. And then only until after 30 minutes later, after the economic release, did it start to head lower, or let's say after 30 minutes, it was lower than the initial market reaction. And same for the NQ, and also the Dow as well. Actually, for the majority of the market, so it took. So it was still. So the reaction lasted much longer than what was previously seen compared to the other economic releases. So I'm curious as to how long this market reaction is going to last. Let me put it out of the way. And how much of a pullback would we get, and whether or not it will raise the the gain that I made on the S&P, all the stock indexes. See how quickly it does that. But yeah, so that is the deviation sheet. So just a reminder for the, if your question is, how do I get my hands on the deviation sheet? And how do I do that? So what you got to do is sign up to the MACROACE mailing list. Okay. And not only do you get access to the deviation sheet, which is completely free, right? And you can see all the other economic releases that we've covered in the past, the ones we're keeping a focus on. You also get an email every Monday. So this is how it works. You sign up to the MACROACE mailing list. On the Monday morning, you will get an email with a link to the deviations Google Sheet. As I said, that's completely free. That's live in real time. You can see me update it whenever I jump onto it. And for the other other part of it as well, within the email, I put out a little short summary of what to expect for the week ahead in the US, Europe, and Asia session. That's not very long. It's quite short. It's supposed to be a refresher of what had happened in the previous week and what is expected, what events are expected to take place in the week ahead. Again, not a lot of detail because, as I said, it's more of a refresher. I prefer that. And then the live streams here is where I talk to you guys about the economic releases and the sentiment then surrounding those economic releases in much more detail. So just to kind of temper your expectations, if you're thinking that there might be line graphs or bar charts or anything like that, no, it's simple because that's how I like to keep it. But yeah, so that's the link to the MACROACE mailing list. As said, Monday, for those of you, if you have that question as to when you'll get access to the deviations Google Sheet, you'll get that Monday in the email that I send out on that morning. Then, so also FinancialJuice. Now we have a very special offer with FinancialJuice. So let me explain to you what FinancialJuice is all about first, if you're not familiar with it. So FinancialJuice, the news feed, as to what you can see now, is a live voice and text platform. Okay, where you are provided with the up-to-date news of what's going on in the markets, with breaking market moves, headlines that could affect sentiment or could and then affect the markets, and what to be aware of as well, all in one place. So we have a live voice feed here, which is, I've just clicked on here, so you should see me with playing with the slider. Okay, that's there. That's live in real time with no delay. And then here in the middle, you have your news feed as well of the text headlines. We also chart the data as well for economic releases, but also headlines that might have moved the markets as well. All in one place. On the left-hand side, you have your economic calendar as well. That's all live in real time as well with the data that's put out here on the left-hand side. So if you're a day trader, if you're looking to capitalize on breaking market moves and capture those opportunities, then FinancialJuice is the place to be with the FJ Pro version, the live real-time version with no delays to the feed, all in real time, all in one place. That is what FinancialJuice is all about, to let you know about the headlines that are going to matter the most and those that are going to add to sentiment as well. Okay. Now, if you would like to sign up to FinancialJuice and you wanted to have a little play around with it, and you're unfamiliar with, or you're unfamiliar with what FinancialJuice or how to use news, fundamental news within your trading, then you can sign up. You can still sign up to FinancialJuice. You'll have the light version of FinancialJuice, which has a delay to the news feed overall. There are also the adverts that play as well, and you have advert banners, and you don't have access to the news desk here to ask people, to ask the analyst on questions about what's happening within the markets, why the market's moving in that way, and if there are and any other technical questions you might have about your subscription to the service. Yeah. No. All right. So, yeah. So the best way to do this, if you're unfamiliar with a live voice and text service, is have a little play around with the delayed version. What you should try and do is try and figure out, will having a news feed have an impact on your trading? Will it benefit you? And then once you feel confident and ready, then you can sign up to the pro version of FinancialJuice as well. So the pro version of FinancialJuice, all you got to do is you'll see here a button or here that says Go Pro. Okay, where I've kind of just, or next to that, a little slider that I've just clicked here. You'll see a button that says Go Pro. First of all, the first time you have signed up to FinancialJuice, whether it be pro or non-pro, is make sure you activate, first of all, make an account first, then go to email and verify your email. Once you've verified your account, and you want to go to the pro version, then of course select Go Pro in the top left hand corner, select your subscription, then come back to the news feed, okay, and then log out and then log back in, and then you should have the pro version of FinancialJuice. Now, this is what I want to talk about. We have a special offer for you guys, okay, for FinancialJuice Pro. So, if you want to stay up to date with the latest and be on the bleeding edge of news, then sign up today and get our special offer of FinancialJuice Pro for a year's worth of our service for the price of 1 month and save 92%. Okay, so usually a monthly subscription is $99, but we're offering a year's worth of our service for $99 instead. How great is that, right? And if you've used FinancialJuice in the past, then again, you can get it. You can have a look at it. Make sure if you do already have a subscription, to cancel that subscription and then subscribe to the new subscription that you want. Okay, just making that clear. Don't go and buy the $99 deal if you've already got a subscription. Make sure to cancel the other subscription first, and then select the new subscription that you want. But that is the offer that we have for you guys. I'm sure you must have seen it pinned on our Twitter page as well. That is the link to the FinancialJuice website. Okay, at the bottom of the page there. Crazy to Eccentric says not light starter. Yeah, you could I mean it's called the light version, but yeah, you consider it as like the starter mode if you're looking at how to incorporate a live voice and text service into your day trading. Okay, this is made for day traders, with providing you up-to-date news of the breaking market moves that are happening and the opportunities wherever they may be within for you guys, live and in real time. So that link is there. Let's see, Tony, what topics on 0-day seminar? When you say 0-day seminar, what are you referring to? Are you referring to when's the next one? So yeah, the next one, so will be the final part of Risk On, Risk Off, where I go into more detail about central banks and how they affect the markets depending on what they're doing, whether they're in their hiking cycle or in their rate cutting cycle. So that's what I'll be covering in the next one. I haven't specified a date as of yet. Of course, this week has been a bit busier with the time change, but we should have something scheduled in soon with the next webinar that I do. Okay, and then finally with TICKSTRIKE, I'll shush my mush if you're unless you're not tired of hearing my voice. But yeah, so here is TICKSTRIKE. So if you've never come across what TICKSTRIKE is, it basically allows you to listen into the order flow. Or another way to put it is how strong is the buying or selling momentum within the markets. Okay, so if we're looking at let's bring up the NQ here. So this shows you here with this little box is what we call the ticker, and this shows you how strong the buying or selling momentum is. So this number here is the level of sensitivity of the ticker box. So 1 is the most sensitive to market reactions. So when there's or is very sensitive to market reactions. So when there's a little bit of buying or selling that is occurring within the market or within the asset, then TICKSTRIKE will give you an alert to that there. Okay. Now, of course, the minus symbol shows you the selling amount of the selling that's occurring, and then a plus symbol so shows you the buying momentum. Going back to this number here, so number 1, as I said, is very sensitive to market reactions. I will give you an audio visual alert here and there, or most of the time. Now, if I were to drag this slider up here on the left-hand side of this ticker box all the way to 15, 15 is the least sensitive to market reactions. So only when there's a big amount of buying or selling momentum that's occurring within that asset that you've picked, only then will TICKSTRIKE give you a visual and audio alert to the strength of that buying or selling momentum. And of course, this is a pro version of TICKSTRIKE on the news feed on FinancialJuice. You do have a more limited version, and is restricted to the sensitivity that you can sensitivity. So you can't chop and change that. And you have the 4 different assets. You've got your stock index, currency pair, you've got your crude oil, and you've got Bitcoin there too as well. And I said that's restricted, but the pro version of TICKSTRIKE allows you to do a whole lot more, not just with Forex, but crypto, futures, stocks, ETFs and ETNs, and your internals as well, like the VIX index. Okay, you can have a little measure of that too. And then finally, one little other feature that we have, with what people have asked me about in the past live streams, I think they asked me once or a couple of times here and there, is this lightning bolt symbol. And this basically makes the ticker uber sensitive to the market reactions. Okay, so 1 is very sensitive to market reactions. The lightning bolt goes 15 levels below 1, okay, to where it's uber sensitive. So if you like scalping the markets, then again, this is another tool that you can add to your day trading strategy, or to your tools that you already have. And of course, again, you can still chop and change, but remember you're going from 1 to minus 15 here. Okay, you're going to 15 levels below 1. So you can see that it's a lot more chaotic than if you were to keep it, if you were to not have the lightning bolt on. For me, this is not my kind of style. It's a bit too chaotic. But for you, if you like scalping the markets, or like that, seeing what every little bit of buying or selling moves that occur, then by all means, that's what it's made for. And if that's what suits you, then go for it. But I like to keep mine off. Like I said, it's too much for me. But for you, for you guys who like to scalp the markets or like to see those small changes here and there, then definitely go for it. And that is what it's made for, to whatever you kind of want it to be within your day trading strategy. And that is a link for it as well. FX Pass says, hi, regarding TICKSTRIKE, is it good for day trading FX and equity like ES 3-minute trade at support resistance? That's totally down to you. Like I said, you kind of, here's the best thing to do, right? Have a little play with what's on the FinancialJuice newsfeed already, the free version. as I said, that's restricted to a certain level of sensitivity. I think that's at 6, so it's kind of like just below midway-ish. It's probably a little bit higher, but it's restricted. So have a little play with that and see how that works for you. You also do have a 7-day free trial of TICKSTRIKE anyways, with the link that I've sent to you. And what you should be doing is kind of forming your own strategy of what works for you. Because of course you can use it on, it depends on however you want to use it. So I can't say there is, one way to use it. Some people use it to manage their risk. Others use it to capitalize on potential opportunities that comes through with the extra volatility that might jump into the markets. But again, that's dependent on what you want to do with it. So I can't say yes or no or how to use it at support resistance, because somebody else you could use it in a different way, and I could use it in a different way, and that person might not be used to that, and that's not fair to do that. So best to find your own way with it is what I say. That's what I say with all of this, and also the deviations sheet as well, is to understand and then understand how use the information that we provided, or that we provided in your own way, whatever works for you. Yeah. But okay, that concludes the MACROACE live stream. If you do have any questions, then we'll be happy to answer those later on. If you send us an email at support@financialjuice.com. Okay. There we go. Then we'll be able to answer any more questions that you guys have. But for now, thank you very much for joining me. Enjoy the rest of your trading day, and I shall see you guys next week. All right, take care.